I'm Nicolas Bornozis, President of Capital Link, and I would like to welcome you to the Capital Link webinar and podcast series. Capital Link also has the unique privilege of being the investor relations advisor to Tsakos Energy Navigation, and I'm here today with Michael Jolliffe. Michael is the Vice Chairman of Tsakos Energy Navigation, and he's also one of the founders of the company back in 1993, along with Nikos Tsakos. So we're delighted to have him with us today. And we are going to talk briefly about the tanker market, and then of course about Tsakos Energy Navigation. So I'd like to welcome Michael, to thank him for being with us. And let's start our discussion about the market. The tanker market overall has not been particularly, been a bit on the softer side. Of course, the longer term fundamentals are quite positive. And today, for example, we saw that OPEC announced an increase in their production levels by about 1 million barrels per day. Initially, they had cut back 1.8. Today, they announced that they will increase back about 1 million per day. I think of that, 600,000 are more likely to be available, coming on the production line. So that's positive news. What do you see that how do you see that impacting the tanker market?
Look, Nicholas, I think that the tanker market at the moment is a little bit on a fulcrum. We can see that, excuse me, that the rates are improving slightly. We can see that the forward prediction of rates are, $20,000 a day for a VLCC, excuse me, for the rest of this year. Maybe up to 30 or 40,000 next year, and so on. You're talking about the OPEC increases. I mean, obviously, to increase them back to the 1.8 million barrels that was originally cut is a big step, not because those barrels aren't actually available, but because of the problems that exist with production in countries like Venezuela that you mentioned, like Iraq, like Libya, and so on, where unfortunately for geopolitical reasons, in Venezuela, the government is not able to attract foreign companies to help them produce the oil because of the economic problems that they have. In Libya, they're in a warlike situation where the rebels are constantly attacking the pipelines and the production facilities, and Iraq, for similar reasons, if you like. So I totally agree with your pronouncement, which is that perhaps we'll see an increase in barrels of about 600,000 barrels a day from OPEC. Of course, from a non-OPEC country such as Russia, we maybe see a slightly increased production as well, because this agreement has been reached in agreement with Russia, if you like. So perhaps we might be lucky and see an increase in production of up to 1 million barrels a day, or certainly 800,000. This will undoubtedly help the tanker market, and I think the fact that the tanker stocks, the quoted tanker stocks, have gone up considerably in the last few days reflects people's belief in the fact that that the OPEC production will go up, and therefore that the ships will have additional employment, additional ton miles, and so on. So I think we can see that it's not just my personal opinion, but the market itself. I mean, our own stock has gone up 13% in the last week.
So it's very interesting that now there will be more oil available in the market, and of course more oil means more need for transportation. At the same time, we see that we have the ton mile effect. We see that with the US, for example, being a big exporter of crude, the crude goes to Latin America, it also goes to China, so you have longer distances that will be traveling. What I found particularly interesting, I was looking at your latest quarterly earnings presentation, and you had in there a slide that was talking about the main drivers on the demand side, and China and India are among those main drivers. And you mentioned that China and India together have 2.5 billion of inhabitants out of a global world population of 7 billion. So it's more than a third of the global population in two countries. two economies that are growing quite fast, and you mentioned that for comparison purposes, the consumption per capita in the US is, I think, 23 barrels per person per capita. In Thailand, it's 7 per person. And if you go to China, it's 3, and India, 1. So with those economies industrializing, expanding quite rapidly, if we see the consumption per capita slightly increasing, that will have a catalytic effect on the market. It could double, actually, the quantities imported into those markets with effect on the tanker market.
Well, I think, Nicolas, you make a very good point, because I think, to suggest that China would or India could go to the incredible consumption enjoyed here in the United States would be a little bit far-fetched. But you were very wise in mentioning the consumption in Thailand. Were we to see Chinese consumption or Indian consumption go anywhere near the consumption of Thailand, there would not be enough oil in the world in order to fulfill it. Now we see that the Chinese are starting to use a huge amount of LNG, for example, and we have a play, as you know, into LNG ships. However, that LNG for the time being is being used mainly to replace coal because of the pollution problems they have in China. I mean, the year-on-year increase in imports of LNG into China is something like 47% already this year, and we're only nearly 6 months into the year. And for sure it's going to increase even further, but certainly the importation of oil into China is going to increase even further as people have more and more cars, more and more motorbikes, more and more vehicles that they wish to drive. And in India you have even bigger possibilities because of the size of the population and the fact that they are in themselves so far behind China, but you have a growing economy.
So we have, again, more oil, longer distance to travel. Hopefully that will translate into more demand for tanker shipping. And at the same time, there has been an expression of concern about the order book. But I have the feeling that the order book now is getting more under control.
I think that's right. I mean, I think that obviously the order book is now far more balanced than it was previously. I think also that a number of people who perhaps have been responsible for over-ordering have burnt their fingers a little bit, because when you're building ships in the sort of $50 to $100 million range and you can only charter those ships at a huge discount, shall we say, to the market, you've suffered financially. I think in our case it's a very different question. We have 78% of our fleet on time charter. We have built 15 ships and taken delivery of them in the 18 months up to February of this year. And every single one of those 15 ships, which cost us a total of about $1.2 billion, were time chartered at profitable rates long before we ever ordered them. So our policy is to find a nice oil company who wants brand new ships, who is prepared to pay a premium in order to charter those ships for a long period, and then we go out and order and build the ships against those time charters, and that's been one of the advantages that we've had as a company. So unlike a lot of our peer group, we have not lost the sort of money that other people have made, and in fact out of the 78% of our ships that are on time charter, we are in the lucky position that pays both our operating expenses, both our banking expenses in terms of capital and interest repayments, our preferred dividends, and even we pay and continue to pay a dividend to our common stockholders.
Well, continuing on your point, I would like to remind that Nicolas Tsakos, I think, is well known for two things that he has said at various capital conferences. One, about new buildings. One is, he said, gentlemen, put your pens in your pockets, don't order. And then he said, order responsibly. And indeed, in your case, as you mentioned, you go to new buildings only based on employment, you don't build speculatively.
Well, that is absolutely correct, Nicolas. I mean, after completing what was the biggest new building program in our history, and we have built a large number of ships since 1997, over 100 ships, we then took a little bit of a gap, but Chevron came to us with a very interesting deal. We were able to realize that deal, to sign that deal, and now we're building another 2 Aframax tankers in Korea for 5 to 7 year charters with Chevron. So that's another, if you like, example of us ordering ships, but not ordering ships that are going to put more ships into the marketplace, but ordering ships that are required specifically by a major oil company under a contract that they've very kindly given to us. We work on the principle that were we not to do that business, of course Chevron or whatever Chevron it might be would go out and ask someone else to do that contract for them, so we're not actually adding ships to the market in the same way as people do when they order ships speculatively.
Absolutely. I think another element that will act positively on the market is the upcoming IMO regulations, the environmental regulations, 2020, the low sulfur emissions compliance. I think that will obviously take a number of vessels out of the market because they would have to upgrade or retire.
Yes, I think you're absolutely right. I mean, I think, Nicolas, what we have to remember is that the mathematics involved behind this are very substantial, and I think it's going to be a real market mover, if you like. When you look at our fleet, we have 65 tankers, which were all built by ourselves brand new, either in Japan or in Korea, which are all chartered, or 78% of them, I should say more correctly, are chartered to major oil companies and national oil companies. When you look at that fleet, the average consumption of every one of those tankers is something in the region of 50 metric tons per day. Now, 50 metric tons per day probably means nothing to the investors that are watching this interview, but just to put it into a mathematical equation, let us say that currently the arbitrage between high sulfur fuel and low sulfur fuel is in the region of about $250. It depends per ton, that is. It depends where you're ordering that. Are you ordering that fuel in Singapore? Are you ordering it in Jeddah? Or are you ordering it in Rotterdam? But that's roughly correct. Now, the major oil companies, and we've spoken to many of them who are of course customers of ours, believe that arbitrage between the low sulfur fuel and the high sulfur fuel will widen drastically when the regulations come into effect in 2020. The reason for that widening of that arbitrage is perfectly obvious, and that is that there are something like, and it depends on whose database you look at, but there's something like between 85 and 100,000 ships that have to comply with these regulations. It's perfectly impossible to fit scrubbers to all of these ships. In fact, at this moment, I think there's something like 570 ships that are being fitted with scrubbers, and so it's a drop in a teacup, if you like, in comparison to the number of vessels that will be required to deal with these regulations. The major oil companies believe, therefore, that the spread between the high sulfur and the low sulfur fuel will widen to something like $400 a ton minimum. Now, we consume, as I said, on average about 50 tons a day. That means that the arbitrage between the high and low sulfur fuel is something like $20,000 a day for the ships in our fleet. Now, of course, ships do not trade 365 days a year. I wish they did, in the sense of steaming 365 days a year. We do enjoy a utilization in our fleet of something like 97%, but not all of those are steaming days. So perhaps on average, because it depends on the size of the vessel, between 37,000 and a VLCC, but shall we say probably the average about 250 steaming days. So 250 steaming days times $20,000 a day, the arbitrage is $5 million per annum. It's a tremendous amount of money. Now, we as a company own 65 ships. That's $325 million per annum is the cost of the arbitrage between the high sulfur and the low sulfur fuel. So obviously there are good reasons to think that you should fit some scrubbers, especially to very modern vessels or to new buildings. And we can see from the time charters that were being offered from major oil companies that most of those time charters would require us, were we to build the ships for that particular oil company, would require us to fit scrubbers to the ships.
So let's remind our audience that Nikos Tsakos, who is the president of TEN, he's also the chairman of Intertanko, the industry association of the independent tanker owners. So he has been at the forefront of the industry's response to those compliance requirements. Now let's conclude our discussion by talking a little bit about TEN. Of course, we have mentioned quite a few things about TEN and what makes the company very different and unique. Let's remind our audience that you're celebrating now 25 years of continuous growth and 25 years as a publicly listed company. There are many things we can say about the company. You have been an uninterrupted dividend payer since we got listed on the New York Stock Exchange in 2002. Regardless of the market's ups and downs, you have continued your payments to dividend payments. Many good things we can say about the company. I'd like to point out two. Number one, that the family has tremendous skin in the game, and I think to investors that should hopefully be a very reassuring element. And number two, you are one of the very few companies worldwide where the family's name is on the funnel of every ship, which I think indicates a completely different degree of commitment to the industry and to the company. So tell us a little bit more about the growth. I mean, you started in 1993 with 4 ships, now you're at 65, 66. The company is diversified into the energy sector. You're a pure play in the energy sector, but you have, within that sector, you have product tankers, crude oil tankers, LNG, so you really capture all of the needs of your blue chip clients in the sector. So tell us a bit more about TEN.
Look, I think that we could say that, you know, when Nikos and I first started this company going back to 1993, it was with a specific purpose in mind. And that was that in 1989, the Exxon Valdez had the awful accident that it had, and which goes down in history, if you like, one of the worst oil spills ever to take place in history. And as a result of that oil spill, you had, first of all, the United States and then the IMO enact legislation or regulation that required ships to have double hulls. This was fed in over a lengthy period, but it meant that every single tanker in the world had to be replaced with double hull ships. Nikos and I saw this as a huge, huge commitment, if you like, to replace every single tanker in the world. And we thought to ourselves, well, it may be necessary for people to be able to raise additional capital by way of the public markets in order to fulfill this obligation. And therefore, as Nicolas said, in 1993, we floated a company on the Norwegian Stock Exchange. Now, we didn't have the means to build double-hulled ships at that particular moment, but we bought 4 second-hand vessels, which is how we started the company, with a very small market capitalization of $35 million. It seems ridiculous looking back on it in those days. It's quite amusing almost. You know, $35 million wouldn't even buy you 1 ship today. But at that time it was exciting, and we were forced to float it on the Norwegian Stock Exchange because obviously it was too small to float it on an American stock exchange, of which there were 3 at the time, the Amex, the NASDAQ and the New York Stock Exchange. And we were lucky enough that we were able to make a success of that company, and we grew it organically, buying second-hand ships between 1993 and 1997, at which point we had a stroke of luck, if you like, and that was that there was a currency crisis in Asia. Particularly important was the won, the Korean currency, and the yen, which is the Japanese currency. They collapsed in comparison to the dollar, and this enabled us to go out and order brand new ships at a substantial discount because of the value of the currency to the US dollar. And since 1997, we have never ever bought a second-hand ship. Perhaps with the exception, and I don't really see it as an exception, that in 2006 we bought a block of 9 vessels, most of which were still under construction, and a couple of which, the oldest of which, if you like, was 10 months old. So, and these were a block of ships that were built in Hyundai Heavy Industries, which was the yard in which we built a great many of our own ships. Anyway, we were lucky enough to be able to do that, and we continue to grow the company gradually over the years until today, which Nicolas correctly says we have a total of 65 ships, 63 of which are product and crude oil tankers, and 2 of which are LNG carriers. You know, we are fully committed to build more ships. We are ship owners. We're not financiers. We're not ship operators. We are ship owners, and we are here for several lifetimes to invest in the shipping business, and hopefully to make sure that those that invest alongside us profit from that investment.
Michael, if I can add, besides the idea of order responsibly, I think you have also followed the principle of charter responsibly. And I think, as you mentioned, the fact that right now, in the current market conditions, and we have a weak market condition, 78% of your ships are under time charter or other profit-sharing arrangement, enables you today to enjoy a TCE that is more than 100% above the market, the spot market. And I think that indicates that you really try to navigate the business regardless of the cycle.
Look, I think you know, we're conservative people. I wouldn't like to say we're rocket scientists, because that wouldn't be the case. But we are somebody that are totally committed to the shipping industry, and that's what we do. We don't do other things. We are purely invested into shipping, and we believe that we have a commitment to the people who invest alongside us, whether those people are our common stockholders, whether they're our bankers, or whether they're our preferred stockholders. We have an obligation to meet our, compliance, if you like, to those people. Now, I think we can say that going into the sort of post-Lehman Brothers period, there was a moment when many of our competitors, and many of them are splendid and good companies, had problems, and they had to go back to their banks and renegotiate their bank loans, perhaps taking a holiday on capital repayments, perhaps winding up some of their interest payments into for some time. We never had to do any of that. We were able, luckily, to pay all our capital and interest repayments in accordance with the original bank loans that we negotiated with the banks. We were able to continue paying our dividends to our preferred shareholders, and even, and unlike nearly all of our competitors, we didn't stop paying dividends to our common stockholders. This was not because, as I said, that we're particularly smart or rocket scientists or something, but it is, as Nicolas said, because we are conservative people, and we believe we have an obligation to those that invest with us above the obligation to ourselves. And I think that's most important. It's not that we're saint-like, but it's just that if you want to maintain and run a long-term business, you have to satisfy the people who stand alongside you before you satisfy yourself. And this has been the important goal that Nicolas Tsakos has set for all of us, and I hope that I have been alongside him all of that time and in agreement with that policy.
And Michael, concluding our interview, you just completed successfully a preferred capital raise of 135 million, and if the green suite exercise will be 155. It's worth pointing out, as we discussed, that you started to raise 50 million, and I think the demand has been so overwhelming that you are at 135 and possibly 155. So I think it is quite factual to say that that indicates the confidence of the market in you.
Well, I think we could say that first of all, we were very lucky that we have the support of some of the biggest underwriters in the US, if you like. I mean, the list of underwriters that we had on that offering was Morgan Stanley, JP Morgan, Union de Banque Suisse, Credit Suisse and Citibank. All of these are banks that have shown us enormous support both on the investment banking side and in some of the examples that I gave there on the commercial banking side as well. So we have sometimes a dual relationship and sometimes a singular relationship, but those are 5 of the biggest banks in the world, and they were there to support us on this offering, but not only, in many other ways as well in our business. So that was obviously a very good start. Now this was a very difficult week. When we entered the week, the market was down. It opened down on Monday. We decided to postpone the offer. And this continued through until Thursday in various degrees. And even on Thursday morning, luckily it opened less than 100 points down. But by an hour after the opening, it was already 200 points down, which would probably have meant that the underwriters might have held off the issue if they had known that the market would fall that far. But despite the fall in the market, there was huge demand. Excuse me. There was huge demand from retail investors because, as you know, these preferred issues are retail investor orientated, and particularly from the private banking side of some of our major banks. So I mentioned the banks earlier. All of them have big or smaller private banking operations, and the clients there trust us. The reason they trust us is the reason that Nicolas and I discussed earlier, which is, first of all, that we've been very honest, I hope, with our shareholders, with our preferred shareholders, with our bankers, and always paid them. And secondly, I think because we have, this is the 5th of the pref issues that we have out there, and every single one of those pref issues, we paid the dividend on time in accordance with the agreements we signed. So we understood from some of our bankers that some of the demand they had was unrequited. In other words, there was a huge over-demand for our particular pref shares, which in a down market was extraordinary. Now, not only was the market going down in general terms, but at the same time, quite perversely, our common stock price was going up. And so since the beginning of this week, our stock price has gone up 13%, despite the issue of our Series F preferred share. And we are confident that that will trade above market, as all our preferred shares have done so far. They've traded above par. But any of you out there who have bought those shares, thank you.
Michael, thank you very much for being with us. We had the pleasure of having Michael Jolliffe. Michael is the Vice Chairman of Tsakos Energy Navigation and the co-founder. And I'm Nicolas Bornozis, President of Capital Link, and we have the privilege to serve as Investor Relations Advisor to Tsakos Energy Navigation. So, Michael, thank you very much for this very informative discussion and interview.
Thank you, Nicolas. And we're very lucky to have you as our IR company. Thank you so much.
Thank you.
Thank you.